are going to be reviewing a live demonstration of the new ACA decision support tool. We have a very full house today, so everyone is going to stay on mute to eliminate background noise. If you have a question during the webinar, please type it in the box over to the right. We'll try to answer those questions at the end of the presentation. However, after the presentation, if you still have questions, please feel free to contact Associated Benefits Consulting. We're going to give the email and their telephone number again at the end of the presentation. But their email address is aca@abenefitsconsulting.com. Their phone number is area code 877-291-9256. Our presenter today is Arthur Ticino. He is the founder of ACA Solutions and the creator of the ACA Solutions tool. He is an assistant professor of health insurance at the American College, and at the college he has been responsible for the design and teaching of 2 comprehensive courses on the Affordable Care Act, and he is considered a leading expert in the country on the ACA. As one of the thought leaders in the field, he has created this unique tool to help agents and brokers deal with the complexities of the Affordable Care Act. So at this time, I'm going to turn it over to you, Arthur.
Thank you very much, and welcome everyone to our demonstration today of the ACA Decision Support Tool. This is a tool that we've created with a lot of feedback from the industry. As a professor is teaching the Affordable Care Act to agents and brokers all over the country, I really felt like there needed to be some sort of practical tool that could help agents and brokers kind of wrap their arms around the Affordable Care Act and also, help them understand the impact that's going to have on their clients and present that impact to them. Show them, what are the compliance issues, what are the cost issues, there are new tax liabilities. So there's a lot, the Affordable Care Act is kind of a beast or a monster, and this tool is really built to help an agent or broker wrap their arms around it and help their clients understand the financial and compliance impact that the Affordable Care Act has on them. And truthfully, right now is the time that all agents and brokers need to be sitting down with their clients. We're right on the horizon in 2014 are monster number of changes coming down, and employers need to make decisions today. Right now, April 19th, 2013, an employer can make a decision that'll help their cost, their bottom line, help with compliance issues. Obviously, this is being driven a lot by the employer pay tax. So what I'm going to do today is kind of go through the ACA Decision Support Tool to give you a feel for how this tool actually works and what a user would be seeing and doing within the tool, and kind of showing off some of the capabilities as well as the different applications within the software. You'll also see specifically that this is a NAHU specific version of the tool, and as a member benefit from being a member of the National Association of Health Underwriters, essentially what you are getting by purchasing is you purchase first off at a discounted price for an annual license of $650. And within the tool, what you'll see is that you'll have access to additional applications, and there are additional calculations that are running that we have developed by working with the leadership of the National Association of Health Underwriters. So specifically trying to enhance it and add things that that NAHU knows that you guys are looking for. So that's what we've done here. That's kind of the benefit. And when you sign into the tool, what you're seeing right now is the actual dashboard. You'll see the National Association of Health Underwriters website, and then as you scroll down here, what you'll see is there are 2 things: the employer survey, and you can make that bigger. You can also shrink that down, and you'll also see the healthcare consultant checklist. And these are 2 of the foundational pieces of the software. The software is really driven by the employer survey. This is a survey that collects key pieces of information from a client that basically allows you to run cost modeling and other scenarios for a client. So when you start off, this is what you'll see. But within the tool, there are several different applications. So if you go to the ACA Decision Support Tool, you'll see that we have different modules for different pieces of the law. For example, we have a module that helps calculate any Cadillac plan tax that the employer might be subject to starting in 2018. We have different strategy modules. So for example, something that employers are considering doing are dropping coverage and converting full-time employees to part-time status. This is something that would help them limit the amount of tax liability they have under the employer shared responsibility tax or the player play tax. There's a module to help cost model what if we dropped coverage but increased key employee salaries only. There is an employee survey function within the software. So for example, if you had a client who had, let's say, 80 employees, and you wanted to know how many of those employees would actually be eligible for a cost-sharing subsidy through the exchange, you can email a survey out to their employees, which collects information about not only plan satisfaction, but their household income, their household size, which is what's going to dictate whether or not they're eligible for a subsidy. And, part of the decision-making process for an employer is, well, what if I have a very large population of employees who might be better off going to the exchange and purchasing subsidized coverage? There is a full-time equivalent employee calculator. Obviously, this is one of the big things that employers need to track throughout 2013 to determine, are they what's called an applicable large employer, which would mean if they are, they're subject to the player pay tax in 2014. This calculation is really going to be important for those employers who are right on the brink of having 50 or more full-time equivalent employees. There is a healthcare checklist, so many of the provisions of the law are really contingent on the size of the employer. How big are they? How many full-time equivalent employees do they have? How many full-timers, part-timers, seasonal workers? And based on that number, which provisions apply to them? So, for example, the small business healthcare tax credit, exchange eligibility, the player pay tax, W-2 reporting, eventually automatic enrollment. So this checklist helps the agent or broker not only understand what provisions are out there, but which ones specifically apply to this client based on their circumstances. We've also worked with NAHU leadership to create a measurement period module. This is associated with the player pay tax. So we know that the number of full-time employees is what's going to be used to calculate the penalty under the employer shared responsibility tax. So what we've done is we've built in a module to help create a timeline for what the measurement period would be and what the administrative period would be, and then what would the stability period. And during the stability period, that is where we calculated the measurement period, how many hours did they work. If they work 30 or more hours a week, then we count them as full-time during the whole period of the stability time frame. And that obviously is going to affect tax liability. So it helps. What this does is it does not track the hours of service, but it helps create a timeline for when you need to be tracking. And that's something that obviously you want to be able to advise your clients on. We are working and in development in creating a module that's not released yet to help an employer who wishes to offer coverage make sure that the coverage they are offering is quote-unquote unaffordable under the regulations. And we're calling it the immunity testing module because, if you're an employer who offers coverage, two things you need to be worried about are, one, is the coverage minimum essential value, meaning does it have an actuarial value of 60% or greater? And what the IRS has done is they've created a minimum value calculator. And what we've done is we've made it in the software. You can go ahead and download that and use that, plugging in the employer's plan information to determine does it meet that 60% actuarial value or not. And also it shows you what is the wage base using the W-2 safe harbor given through the regulations to make sure that the coverage is affordable, meaning that it doesn't cost an employee more than 9.5% of their compensation to purchase employee-only coverage based on the lowest cost plan. So this would basically assure the employer that, yes, the plan you are offering based on the contribution levels, you are not going to be subject to any tax liability if you offer this plan. So you're immunized, in essence, from tax liability. The plan comparison module, just as an overview, if you're offering more than one plan, you would have to create a survey for each plan itself. But then this module helps you sort of total the costs of, let's say you're offering an HMO, a PPO, and then one other type of plan. You can plug in the survey for each one of those and then pull them together and sort of show them the overall cost of all plans being offered. There is a resource table which really just links you to several different resources that are available. one of which is the minimum value calculator. Other, for example, some of the others are certain websites like NAHU's website, like the Kaiser Family Foundation website. Also, things that the government have created. They've created model notices. They've created a model summary of benefits and coverages, or 4-page summary of benefits. There is a simple cafeteria plan module that can also be used as a defined contribution module. And for those of you dealing with much smaller clients, there's an independent small business healthcare tax credit calculator. So it collects information about the employees, the hours of service worked, the wages they're paid, the non-elective contributions they're making, and it helps determine A, are they eligible for the subsidy, and B, what is the subsidy amount that they're going to get, the credit amount, based on the non-elective contributions they've made. So that's kind of an overlooking view of what the software does in the different applications. Just to make you aware, this is hosted online, so it can be used by any device that has access to the internet. And it's been tested on desktops, laptops, tablets, so it works with an iPad or another tablet. It works on a smartphone. Now, practically speaking, it's a lot harder to use on a smartphone because it's very small, but as long as you have internet access, you can pretty much use this tool anywhere. So you can use it, in front of your client. You can use it back in your office. However your style of doing the business is, you can adapt it to that. It is hosted in a way that we can go in and make any changes to it as the law changes. So many of you probably are aware that the law is constantly evolving. New regulations are constantly coming down. So if there's a significant change to the law, maybe the penalty amount of player pay tax changes, we can go in real time and adjust the calculations to make sure that you're giving your client, when you're using this tool, the most up-to-date, credible information that exists. And that's something that we kind of pride ourselves on, and one of the things that we really love about the tool itself. Now, what I'd like to do is kind of walk through the employer survey because, as I mentioned, this is what really drives the entire tool and all the other pieces of the tool. So I'm going to open up a survey that I've already created called the NAHU Demo Sample. Basically, what you can do is you'd enter a client. You can create a new client, or you can pull up a survey from a client you've already had. I've already created my client here as NAHU Demo Sample. You can use this tool for as many employers, as many clients as you want. There's no limitation on that when you purchase an annual license. You can alter or amend the survey as your client's circumstances change, and I'll show you how easy that would be to do. But this was created by me. As you can see, when you signed in, the license belongs to Arthur Kino here. And then it's going to collect key pieces of information that are all tied to the Affordable Care Act. So the number of full-time employees, and what I'll do is walk through and kind of explain what we're collecting here. And I'll try to get through the survey and a couple other modules. I'll move slightly quickly. If you have questions, we'll try to get to them. But hopefully this sort of explains itself as we go through. So we're collecting the number of full-time employees. What is the expected rate of growth or downsizing for the employer? Again, the size of the employer matters greatly. And if the employer is going to grow or downsize, that's going to affect which provisions of the law impact them in the future years. What average number of part-time employers are working? How many hours a week on average are they working? Do you have health care coverage to offer to your employees, and what type of coverage? I just put an HMO. I've already run the numbers through here, so what you can see is it's going to run there are data input fields like these, and then there are calculated fields like this that tells us, based on the number of full-timers and the average number of part-timers and the hours they work, the number of full-time equivalent employees for this employer would be 98. And as you'll see within the software, there are these green notes beneath both the calculated fields and the input fields. What they are, in essence, is a tutorial to why this is relevant to the law. So, for example, enter the number of full-time employees. Well, you might say to yourself, how do I know if they're full-time? Well, we put in a tutorial note here that says the number of full-time employees are defined by anyone who works 30 or more hours a week, as defined by the IRS. So, what it tries to do is, for those of you who have vast knowledge of the Affordable Care Act, you probably don't need to really read the notes as you go through. But for someone who's maybe kind of trying to tackle it still, These notes are built in to help you along and help you understand the business logic of why am I asking this question? Why is this relevant? So why does it matter if the employer grows next year or downsizes? Well, here's a note about why this would be important or significant for the employer to understand. So it tells you the expected number of full-time employees in both 2014 and 2015 based on the expansion rate. Then you're going to collect information about the plans that are being offered. So in here it has employee-only coverage, employee plus spouse, employee plus dependent or children, and family coverage. So you're going to put in the monthly cost. And what you're entering is the overall monthly cost, because later you're going to be asked to enter in contribution information. So how much is the employer contributing? Very important note and important piece of this as far as the cost modeling is concerned is what is the projected increase to premiums for the next year? Because we all know premiums are rising due to the Affordable Care Act, and when you're trying to do an analysis for a client, they need to understand that if they offer this plan next year, the same exact plan that they're doing in the current year, it's going to cost them more money next year. Not only because of premiums, but also because of potential tax liabilities and other compliance issues. So that's part of a very important part of the cost modeling that the tool does is based on this number alone. And there's a tip that many studies suggest that a 7% increase is what's going to happen, but you might actually know what that premium increase will be. You might have been told by the carrier to expect a 15% increase in premiums next year for this plan. And as you can see, the calculated fields have run, and they're showing basically, what it's going to cost on an annual basis total for family coverage. It's $10,560. And let's say that the employer's information is changing, and you went back in and said, actually, it's going to be $920 this year. You simply go in, change the number, hit save your changes, and it's going to rerun all the calculations that are going on in the background. And then now, for this year, it's going to be $11,040. Now, at this point, you're going to go to the bottom here because you're going to open up a different type of question. So these questions are about the employee classification information. So it allows you to enter information based on the class of employee. For this example, we're just using one class. Let's say everybody's considered Class A. It's going to ask you what is the employer contribution for employee-only coverage, what's the contribution for employee plus spouse, for employee plus children, and for family coverage. So here, I put an 80% contribution for employee only, 70% for employee plus children, 60% for employee plus spouse, and a 50% contribution for family. And the reason that it's helpful to do it by class is you might say as an employer, well, I'm going to make a higher contribution for all of my upper level people, and for my lower level people, I'll make a 50% contribution on each tier of coverage. Well, this tool will allow you to go in and put in the information for your upper level people, their Class A, and then go back and put in Class B, and you'll put in the contribution rates for that classification of employee. Then it collects the enrollment information, so how many people of your Class A employees are enrolled in each plan. We put in 20 here for simplicity. Then what the tool, which is a very helpful aspect of it, is it asks strategy questions. Based on the input that you put in here, it's going to help project certain things. So for example, the first strategy question is, would you consider decreasing your employer contribution to the plan? And if so, by how much? Because one thing employers are considering doing is, let's say we just decrease our contribution so it costs less next year to have the same plan. So I put in a 10% decrease in the contribution. Another strategy question is, what if you dropped coverage, because employers are considering that, but we grossed up employee salary? So we said, for everyone who is enrolled in this plan, we'll gross up their salary by X amount of dollars. And the way the tool works is you gross up by classification. So maybe for your upper level management, you'll gross up by $2,500, but for everyone else, you'll only gross them up by $1,500. So it allows you to do it in that way. And then the other important factor that it helps project the cost of is, if we drop coverage, what's turnover going to look like? What is our turnover going to end up being? Because there is going to be employee turnover. People are going to leave to another employer where their coverage is being offered still, because obviously benefits are a very important part of American life. So this helps project the cost of turnover. So what is the average compensation for this classification of employee, how many months would it take to replace them on average, and then if you drop coverage, what is your expected increase to employee turnover? I put 10% here. The nice thing about the tool is this. They are going to ask you to make certain assumptions about these things. How do you know how much turnover there will really be? You as the user can make these assumptions on your own. That's up to you. Or you can simply let the employer make these assumptions. So you can ask your client, if you drop coverage, what would you anticipate the turnover being? You think it would be as low as 5% or as high as 50%? So you can either drive how these numbers are working, or the user can. And as you go through and play with the tool, you'll learn how to manipulate the numbers to show kind of what you're intending. So some people will use this as a consulting tool, where they'll say, look, these are all of your options. Other users will say, look, I want to show the employer that they should keep coverage. In a sense, you can manipulate the numbers to show them what they might be facing in a worst case scenario or in a tough situation, where if they drop coverage, employee turnover would be tremendous expense to them. If they increase their employee salaries, that's going to be a tremendous expense to them. So once you've entered this information, and again, let's gross up their salaries by $3,000, so I'll change that. I'm going to save the changes, and then that's going to rerun the calculations. So it's going to take us back to the main part of the survey, and as you can see, based on that, it's done a few things. One, based on, and what's happening here in the software is it's identifying the largest required employee contribution for employee-only coverage. Now, based on that, it's reverse engineering the tax code to show us what is the minimum wage that all full-time employees must be paid at or above to avoid basically interfering with that 9.5% affordability test. So here, based on the required employee contribution, if you've compensated everyone at $13,894.74, and you can use the W-2 safe harbor to assure this, then you know that you're not going to run afoul of that 9.5% affordability test. Let's say it does ask if you have any full-time employees who are compensated below that wage base, because if they are, you could have some potential tax liability even though you are offering coverage. Based on the gross up of salary, it would cost an additional $240,000 in salary. Our projected cost of turnover is $60,000. And again, by playing with these numbers, you can get them to come out differently. And as you use the tool, you can see the various ways you can do that. Something we added in for the National Association of Health Underwriters specifically because Janet Troutwine asked me to put this in here is, well, if we gross up salaries, those salaries now are subject to payroll taxes. But not only are the increased employee salaries subject to that, the money that the employee was required to contribute to the plan, that was not considered subject to payroll tax. But now, because you've dropped coverage, whatever the employee was contributing, let's say it's $1,000, well, that $1,000 is now subject to payroll tax. So this number, $41,943.42, not only includes grossing up employee salaries, but also if we drop coverage, that the money that was being contributed to the plan that was avoiding payroll taxes is now subject to it as well. You are asked about the client's marginal tax rate, and that is extremely important because if you're looking at an apples-to-apples comparison of the costs for the employer, the player pay tax is not tax deductible. But contributions to an employer-sponsored plan are. So we look at the after-tax cost of both scenarios to give them what's really bottom line going to cost you to do this. Then there are some questions that are related to the law. For example, are you concerned about non-discrimination testing? That could trigger an idea of maybe giving a simple cafeteria plan. Do you utilize a wellness program? That's a trend that we're seeing in the industry. Does the employer have any monetary interests in other business? And the reason we asked this question, we added this specifically to this version, is because the aggregation rules and the controlled group rules of the Internal Revenue Code apply when it comes to the player pay tax. So this would raise a red flag. If they have any monetary interests, you would want to talk to a tax attorney or a benefits attorney to make sure they're not going to run into any issues with this. And then, do you have a strategy to deal with healthcare funds? The The reason, this question is purely just to open up a dialogue with the client. They're talking to you because they don't know what to do about health reform. So you're going to use this tool to give them what their options are. Now, if we keep going down the survey, there's also information you can plug in about if there's a consumer-driven health plan. Do we offer an FSA or an HRA? Do we offer an HSA? I put no in, but if let's say you did, you would put yes, and then what's the contribution you make on average? What percentage of employees participate in that, and that's going to tell you how much it's going to cost, on a defined contribution limit. Also, what is your contribution level towards any ancillary, voluntary, or supplemental policies? So basically, this part of the survey collects information about the types of coverage you offer, and it has a pretty laundry list of different ancillary or voluntary products that can be made available. It asks about the participation in these products, and if you contribute anything to these products, how much do you contribute? So that again, that's going to be part of the overall cost of offering benefits to your employees. And then the final part of the survey addresses in 2014, and again, this is related to a strategy. If you drop coverage, but let's say you increased employee salary, you paid for the cost of turnover, would you also make available ancillary or voluntary products and make any sort of defined contribution towards them? Because that might kind of help swell employee turnover. But so here we're going to leave it blank for just because we don't have time purposes to go through all of that. And another, probably one of the most important pieces of all of it is it does project employer pay tax liability. So here, this employer, on a monthly basis, and again, just to be clear, the law requires the tax is calculated on a monthly basis. It's not going to be collected on a monthly basis. It'll be collected on an annual basis, but you are looking at it on a monthly basis. It would be $9,833.53. And if you, assuming the same number of full-time employees throughout the year, which that could vary up or down, it would be roughly $118,000 worth of tax liability for the year for the employer. Now, we've also built in, related to the Cadillac plan tax, will there be any potential Cadillac plan tax based on the coverage that's being offered right now? Well, under the code, and again, this is really running the calculations from the Internal Revenue Code, based on the coverage being offered, there is no Cadillac plan tax. But if there were, you could go to that other Cadillac plan tax module or application within the software. It would pull in information from this survey, and I'll show you how that kind of works. And then you could show, basically not only that you're subject to it, but what is the potential tax that you have. For any one of these, you're going to be able to generate a report. You're going to be able to add notes. So you might have specific notes you want to make about this client. You can do that in a Word document and attach it so you can later pull that up and look at it. You can email a copy of this to yourself, to your client. You can print this out. You can make a copy of it and then put in alternate assumptions. Let's say you want to show the client what if next year enrollments go up. You could do that and show them, based on that, what it will cost. And then you can create a report. So we're going to go to Document Merge here, and we're going to generate this NAHU client report. So we're going to open it up, and what you need to know about the reports is they will always be generated with the NAHU logo here, and this is what they will look like, but they are totally editable. So if you, let's say you want to put your own logo in there, you would simply click on the NAHU logo, you can delete it, you can insert your own logo. So let's say we want to get rid of that, but you want to insert a graphic or a picture of your own logo from your desktop or your computers at work. It's going to pull in information from the survey and the calculations that were run. So it was prepared by me on this date for this client. And the report, the first initial report driven by the survey, shows three different options. One, continuing to offer the current coverage you have. Two, dropping coverage in 2014, and we'll look at the factors involved in that. And three, what if we decrease the employer contribution towards the cost of coverage? Again, all going back to those strategy questions that we asked during the survey. So here, the first one shows the monthly cost of offering coverage, and this is pre-tax. the annual cost, the minimum wage that was required to avoid offering unaffordable coverage as related to the 9.5% affordability test. Remember, we did say that we had employees who were compensated below this wage base. So here, there's potential $45,000 worth of tax liability on an annual basis. We did say premiums would increase. So from 2013 to 2014, you could see an increase of roughly $29,000 of increased premiums. And then again in 2015, it'll go up by another $31,500 roughly. We did not put any information about ancillary or voluntary products. Here's the marginal tax rate. Based on the marginal tax rate and what is tax deductible, you would roughly save almost $126,000 after tax if you were offering this coverage. So here, the current after-tax cost of coverage is roughly $293,916. In 2014, that would go up to $359,409, and that includes the increase in premiums and the tax liability, which is not deductible. And in 2015, the same coverage would be $381,000, so almost $90,000 more just 2 years later. The second option we said shows dropping coverage. So here it shows the estimated tax liability under the player paid tax both monthly and annually, the cost of employee turnover, the cost of increasing employee salaries. Again, we said that you could enter information about any ancillary or voluntary products and the contribution you've made. Again, the additional payroll taxes. Now, some of these expenses are tax deductible, although the player paid tax is not. So here, it does show that there are some tax savings, but the after-tax cost of this strategy, which is, again, dropping coverage, increasing employee salaries, paying for employee turnover, and additional payroll taxes, it's roughly $370,000. Now, again, an employer can see that, if I drop coverage, it's going to be actually $10,000 more expensive than it would have cost me based on the enrollment figures to have coverage next year. And then finally, what if we decrease contributions by 10%? Remember, we said 10% in the strategy questions. You could put whatever you wanted. So here, it would actually be, each month it would be less if we had to contribute 10% less to each plan. The minimum wage actually goes up, and the reason that is because the contribution went down by 10%, meaning that the required employee contribution went up. And that would mean that, it's going to change the wage base. And then increase employee premiums, the premiums for next year and the year after. There obviously are still tax savings. So here, we went down to $247,000 in the current year. That is if we had decreased the contribution by 10%. Next year it would cost $309,000 as opposed to $359,000, and the year after is $328,000. So again, you are saving the client money, but you're showing them what if you did a 10% decrease. Where would you be as opposed to if you just kept everything the same? And then obviously compare that to option 2, which is what if you just dropped coverage, instead pay instead of play. And as I said, let's say you don't want to show some of this information to a client. Let's say you just want to erase option 3. It's totally edible after you generate the report. So you can just subtract that out, and now you're just showing option 1 versus option 2. And again, you can input your logo. You can do it. So for all the reports, once you've generated the report, you can edit them. Now going back to the tool, that's the employer survey. Again, just collecting all pieces of information that are just relevant to the Affordable Care Act and to the employer benefits. It's going to run the number of full-time equivalent employees, the cost of coverage, contribution rates, the minimum wage based on the 9.5% affordability test, cost of increased employee salary, turnover, payroll taxes, and then any consumer-driven health plan or voluntary ancillary product that you're offering, the player pay tax, and the Cadillac tax. So that is the main thing that's driving the majority of the rest of the software. There are standalone features to the software that are not, pulling information from this, but this is really what's driving the rest of the tool. So we'll go back to our applications just to show you how you could utilize this. The next kind of foundational piece is the checklist. So here, if we click on the healthcare checklist, I'll show you how when I say it pulls in information, I'll show you how that works. If we add a checklist, you're going to click on the client box, and here, our client was NAHU demo sample, so I'm going to click on that client, and as you can see, it pulled in information that was calculated in the employer survey. Now, there are going to be some questions about average number of part-time employees in 2014 and how many hours they're working. So we'll say 20 average part-timers and 25 hours worked a week. We'll say the same for 2015. And then once we've input that information, we'll save our checklist. And again, you'll always see these tutorials throughout the entire tool to help you understand why you're asking these questions. It tells you, based on the size of the employer, they're going to be subject to the employer pay tax. They are not eligible for the small business healthcare tax credit. They're eligible for a simple cafeteria plan. They're most likely not going to be eligible for the exchange. They're not going to be subject to automatic enrollment, and they would not be subject to W-2 reporting based on the exceptions that were created for employers with 250 or fewer employee W-2 employees. Now, again, if something changed in the regulations and they got rid of that W-2 reporting exception, we would make calculations in basically real time and make sure that it reflected the most accurate information, and you would say, okay, now you are subject to W-2 reporting. Again, you can create a report for the checklist. So I'm just going to pull this up. So here's the report telling you the key pieces that are based on the size of the employer and whether or not they are subject to it or eligible for it. Here's a little timeline of other provisions. And again, as a user, you can explain this to the client. You can give as much detail about this information as you want, or you can simply delete and edit this information out. You could maybe, again, just as an idea of how you could use it, you could put a recommendation box at the end, and then you could type, based on the provisions of the law that you are subject to, I think you should do X, Y, and Z. So that's the checklist, and again, it's also sort of a helpful reminder to you, because believe me, I understand that the Affordable Care Act is a monster. It's a bear to get your arms around, and having this sort of backup support to make sure that you're not missing something that was important to talk to your client about, it can be extremely helpful. So that's the checklist. Again, very simple to use, just kind of pulling in information. And while we have some time before we'll try to take a few questions, I'll show you some of the other strategies. So here, I'll show you the full-time equivalent employee calculator. I'm going to add a new client, call them. Again, here's a tutorial of exactly how to use this tool in green here. We're going to put a new client in. I'll call them NAHU demo. Oh, I'm sorry. So what I want to do is create a new client. I'm going to call them NAHU demo FTE client. Call them from Philadelphia, Pennsylvania. We're going to save our client. And as you can see, that is how you would actually be entering the information. So this is just a user experience. And what you're doing is collecting information about the number of full-time employees in January. Let's say it's 45. And then the aggregate number of hours worked by part-timers. Let's say it's 1,200. And how many part-timers are there? Let's say it's 20. So the number of full-time equivalent employees in January would be 55. Now, again, this is all relevant to the employer pay tax. So there are two ways you could really use the FTE calculator. One is you could use it to actually track for the employer in real time how many employees they have each month. So you could tell the employer, I need this information for every month this year. And once you've plugged it all in and you save it, it'll run this calculation and tell you the average number of full-time equivalent employees throughout the year. If it's 50 or greater, they are subject to employer pay tax. The other thing you can do, and I think this is probably the more helpful way to use it, is you can say, okay, I have the first 4 months, of information plugged in here, and I can see that this is kind of where you're headed. Based on the number of full-timers you have, the number of part-timers, and the hours they work, this is, you're most likely going to end up being subject to the tax. But then you can go in and say, okay, if you want to avoid that, which I think you probably do as an employer, you can plug in, the number of full-time employees and the number of part-time and the hours they work and say, if you keep it to these numbers, in the end, you will stay underneath that 50 mark, and you'll have 49 full-time equivalent employees, and therefore not be subject to the player paid tax. So you can use this to help drive decisions about the number of full-time employees, the number of part-time, and the hours their part-timers are working. And if an employer maybe lets go of a couple people or limits the number of hours worked by part-timers, they could potentially avoid the player paid tax altogether. So this is the calculator to collect the information for each month, run the calculation, which is in the tax code, and then average it out over the course of the entire year to determine whether or not their average number of full-time equivalent employees throughout the year was 50 or greater. And just as just to give you an idea of how we're doing this, well, in the most recent regulations for the player pay tax, it said if you do the calculation and there's a remainder, so let's say it's 50.3 full-time equivalents, you drop the remainder. So that is built into the calculation that's being run, so that it's accurate every time you do it. So that's the full-time equivalent employee calculator. If we go to the resource table, just to give you an idea of how that looks, basically when you open it up, there's some websites. Here's the minimum value calculator, so I'm going to download that right to my desktop or laptop or tablet. You can open it up, you can save it to your desktop. This is something I know a lot of people have trouble finding because the government creates it, but again, they don't make it very easy to find. I'm not really sure why they do that, but you can basically plug in information about the employer's plan and determine whether or not they have a minimum value of 60% or greater. And again, this is created by the IRS, but we're just making it easy to access for you. Here's an Affordable Care Act compliance checklist that's created by the Department of Labor. It links you directly to this checklist. So there's a lot of information out there the government has created that's free to you, but you might not know it's out there. So we created this resource table to make sure that you know where it is. Here's the Form 8941 for the Small Business Healthcare Tax Credit. Links you right to the IRS's website to find that form. So we're trying to pull together resources that we know people in the healthcare industry, agents and brokers are going to need for their clients. So that's the resource table that's available to you. Here's an example of a strategy. So dropping coverage, converting full-time employees to part-time status. So we're going to add a new module, and let's use the client that we already need. So it's NAHU. This is a demo sample. That's the survey that we've created. So as you can see, it pulled in information about the number of full-timers, the expected number of full-timers next year and the year after, the client's marginal tax rate, and very simply, it asks you to make two assumptions. First, what percentage of full-time employees would you consider converting to part-time? So let's say 50%. And again, this assumption can be driven by the user or it can be driven by the client themselves. So you might say, hey, look, I put in 50%, but do you think that's reasonable? And your client might say, no, I would never convert that many, but let's say we just want to put 35%. And then how many hours will they be working as part-timers? Remember, they cannot work more than 30, otherwise they're considered full-time, so let's say 28. Now let's save the module, and you'll see that calculations are going to be run. It's going to tell you the number of equivalent employees based on the new number of part-timers and hours they worked, and the number of full-time equivalent employees. And then it tells you that the initial estimated player paid tax liability was $118,000 annually. By converting 50% of our full-time employees to part-time status, the new tax liability on an annual basis is $26,000 roughly. And that means that we've reduced the penalty amount for our client by simply showing them this strategy by $92,000, which again is not tax deductible to the employer. Now, if they drop coverage and do this, they are going to have employee turnover. So, we still include that cost. And you can see that the estimated after-tax cost of this strategy, based on the cost of employee turnover and the still remaining tax liability, is $68,000. Now, you can use this in a variety of ways. You can use this for cost modeling purposes. You can just use this for the general strategies that are in there to show the employer that they do exist and give you some sort of semblance of how they would work. So again, if you want to generate a report for the client, go ahead and do that. You can open it up, and then here it shows you, the number of full-time employees, number of full-time equivalent, marginal tax rate. It also shows the assumption you made. So it showed that you assumed 50% of people would be shifted, and they would work 28 hours a week instead of full-time hours next year. And then it shows the potential tax savings and the after-tax cost of strategy. So that's just, that's a simple module to use, but it shows you, and that's something, for example, I know Walmart has officially announced that they are going to do that. They're going to shift a lot of their full-time people to part-time status. Going back, because we don't really have time to go through every piece of this, going back to the employer survey, I want to show you a way that this can be extremely effective to use moving forward as well, because I think there's so many different possibilities when we're looking at this. So here, I'm going to go back to NAHU demo sample. One thing you can do is you can copy the entire survey by hitting options and simply hitting copy. So instead of recreating the entire survey but then changing some assumptions manually, you can simply copy it. You can say, I want to copy this record, and then you can basically manipulate the numbers, but without losing the survey that you already made. One of the things that a lot of people are struggling with is, what if we have a management carve-out plan? This is, again, just to give you a brief look at how this can be effective. What if, and I've personally had a client who's had, let's say about 400 employees who are full-time, but they offer a management plan where they only cover 75% employees. Well, in 2014, that employer is definitely going to be considered an applicable large employer subject to fair pay tax. So, how do we show the employer that now you're going to have to offer coverage to at least 95% of our full-time employees, or, we're going to have a huge tax liability. So I'm going to just go in real time, show you how quickly this can be done once you get familiar with the software. So it's 400 full-time employees, let's say 2% growth. Let's say that they have 50 part-timers, they work 20 hours a week. They offer coverage, but let's say it's management carve-out. And then, let's keep the premiums the same for the plan, and let's say the projected increase in the premiums is 7%. So we're going to save this. It's an entirely new record. We didn't lose the survey we already made. I'm going to go down, and then we're going to add information about the class. So here, we're going to say that it's Class A, and we're going to say the contribution rate is 60% across the board for each tier of coverage. And how many employees are enrolled? Now, our initial, the actual enrollment for this year is only going to be the 75 people we're offering it to. But to show them that next year, what if everybody enrolls in the coverage? Well, maybe not all 400 people enroll, but let's say, and again, this is where the assumptions are going to need to be made. Let's say, a good amount, let's say 300 people we actually anticipate enrolling in this. Let's say 150 we expect to enroll in employee only, let's say 50 in each other tier of coverage. That brings us to, do my math right, that brings us to 300 full-time employees. Let's do the strategy. Let's do a 10% decrease in contribution, an increase in employee salary by $2,500. And, let's do $25,000 for the cost of the compensation for this class, let's say 2 months to replace them, and 10% increase in turnover for drop coverage. We're going to save our information here. So now, they only cover 75 people in the current year. We're going to show them that if they had to cover it again, the minimum wage is now changed because the contribution has changed. You can change how many people are going to be beneath that wage base. So out of 400 people, let's say 65 people are actually beneath that. The cost of increased employee salary for all 300 people is going to be $7.5 million. Cost of turnover, that's probably low, but again, you can play with those numbers. Almost $660,000 for payroll taxes. Again, let's just forget all the ancillary stuff just for time's sake. The payer-pay tax liability is $772,000 versus a monthly cost of $664,000. So let's save our changes and show this client next year if you had to at least make coverage available. And then we're going to guess on what the enrollment figures would look like, what your options are. And here you can see that this scenario, it's going to be different. Maybe this client's going to be better off dropping coverage because here, the current, based on the enrollments that we're assuming, it's going to be a $1.3 million, or I'm sorry, $1.24 million to cover all 300 people. But if we were going to consider grossing up salaries and everything the way that people are talking about, for this client to do that, it's going to be $6.7 million. So here, the option is clearly going to be keep coverage. And employers don't understand this, and there's an opportunity for agents and brokers to get in with an employer every day this entire year and show them these different scenarios. Show them using the different modules what it would cost, what is the Cadillac plan tax cost that you might have? What is it to drop coverage and convert full-time to part-time employees? How, using the full-time equivalent employees calculator to help consult and advise the employer on making shifts in full-timers and limiting the amount of hours worked by part-timers. The measurement period timeline, again, that's something that employers are going to be looking for. They need to know, what is this? There are 3 timelines: the measurement, administrative period, and stability period. And there are rules, there are logical rules that say if, for example, the measurement period is greater than 6 months, the stability period must be the equal length. So this helps create an actual date timeline on calendar when you need to start the measurement period, when it ends, when the administrative period ends and begins and ends, and then when the stability period runs. And that's when you're going to continue, keep those people who are found to be full-time as part of the tax calculation. And then obviously for the smaller clients, you have the small business healthcare tax credit. So unfortunately, within an hour, we really can't cover everything that the tool is capable of doing, but I hope through this demonstration it's given you a better idea. Remember that it's hosted online. You can use it with your iPad, whatever tablet you have, your laptop, desktop. There are different ways of using it. For example, some people simply send a Word document with all the input question fields. So they just give the employer that information, say, send this back to me. Once they get it, they plug it in. Some people will use this sitting right in front of the client, walking them through this. It's really up to you on how you want to use it. The reports, once they're generated out of the system, you can alter them or amend them to cosmetically look however you want. Or even erase some information or add information about the player pay tax and things like that. So there's a lot of different ways to use the tool, and we've also put in the resource table to make sure that you know what resources are available to you moving forward. So, and like I said, we update this in real time as changes happen. We are also trying, with a great effort to make sure that we take into account our user feedback, and we add additional enhancements to the tool when they're necessary or when they're feasible of actually adding in. We definitely are trying to work on that at all times as well. As a NAHU member, the benefit, you get a discounted price, $650 for an annual license, and that is a single user license only. It's for one person, and you get the enhanced calculations and modules that we're working with NAHU leadership to create. I do think we have a few more minutes, so if there are any questions Melanie wanted to tee up for me, I'd be happy to answer them.
Okay, perfect. Thank you so much. One of the questions, and some of this is just with the software itself, but what kind of technical support or training will be offered with folks who purchase the program?
That's a great question, and we're very happy to say that we, ACA Solutions, my company, has partnered with ABC Consulting in this whole venture, and they are offering technical support. Part of the NAHU member benefit is not only a discounted price for the license, you can also purchase consulting hours from ABC, and they'll set you up with a trained expert in this, not only in the software but also as training on the Affordable Care Act. You can purchase bundles of hours and set up appointments with the consultants to kind of go through not only the technical support with the software, but also, let's say you had a very complicated case, like a management karma, or like, one of the scenarios I see as being very complicated is restaurant chains, and those are, you're running into a train wreck or nightmare there, but that's where you can buy this consulting services and again, it's at a discounted rate for members of the National Association of Health Underwriters, and they offer the support again. What I'll do is show you even on the website this member information is available to you. They've set up an 800 number where they have support staff answering phone calls about questions that they might have, and again also to schedule and set up any support they need as far as consulting services beyond just technical issues. So here, this is where you would go to the members area, benefits, to look and purchase the tool. There is a shorter demonstration video there, and the information for ABC is on the bottom here. You can send an email by clicking this link, or the number is 877-291-9256. And here are the consulting service costs for associated benefits and ACA solutions.
Okay, thank you. Another repeat question that we have is, how does the software work for groups that are under 50?
Sure. Well, I think that the answer to that is it works pretty much the same. I mean, yes, a lot of what's driving the decision and the tool sort of helps create the tool is the player pay tax. But, for example, if you have a group under 50 and let's say they have 40 full-time employees and 10 part-timers, they're borderline close to being subject to the player pay tax. They're going to need to use the full-time equivalent employee calculator and you can make sure that they don't get subject to the player pay tax. Also, any employer who's offering benefits, regardless of whether they're subject to player pay tax or not, they're going to need to show what the long-term impact on cost is going to be, because a small business who might not already have the financial resources to offer coverage might really start rethinking it once they realize premiums are going to go up. So by doing that initial employer survey and showing them the 3-year costs trend, so not only this year what it costs you, but next year and the year after, I think that's extremely valuable to a small business, because they might have, especially a small business, because they do not have the resources of a large employer. They don't have an HR department. They don't have a team of attorneys addressing the Affordable Care Act and telling them how they're struggling to keep their business afloat oftentimes. And if you can show them in advance, look, you might be in trouble financially next year if you keep offering benefits. Let's find a different solution for you. Maybe you switch to a defined contribution plan. Maybe you go to the exchange. I think it offers great value not only for employers who are over 50 and subject to player pay tax, but also for anyone in that 12-group market, as well as the small business healthcare tax credit calculator, which could be a great advantage for small business if they're eligible.
Okay, thank you. Another type of question about the program itself, while the program is going to be updated as needed with new regulations and so forth, do the users receive updates so they know to go in and do recalculations, things of that nature?
Sure, this is a good question. Once the calculations are recreated in there, if they open up a survey that they already created, the calculations will rerun automatically. But for any significant update to the calculations or the tool, there will be an announcement made and generally an email to all users letting them know, so that they're not confused next time they go in and maybe something has changed now.
Okay, perfect. And I think we should end with, we had a question about how did folks purchase this product, and where do they go to get that, and then also that could lead you to then letting folks know who they should contact if they have additional questions.
Sure, and again, that's on the NAHU's main site. If you go to members, benefits, it'll take you to the ACA Decision Support tool. It'll take you to this landing page where you can purchase the tool by clicking on the shopping cart. You can also purchase consulting hours, and if you want to contact us for more information, you can send an email by clicking this link or calling this 877 number, which is 877-291-9256. And for questions about the tool, it's extension 3.
Okay, perfect. We're almost right at 2 o'clock, and we want to thank everyone for attending today. Arthur, did you have anything else to say, or?
Just thanks for taking the time to look at the demo, and I would hope that you find great value in the tool if you purchase it.
Okay, perfect. We'll also be recording the presentation that has been recorded. We'll be posting it onto our website. email later this afternoon that will have a link directly to the recording so you can go back and review any sections that you may want to review. So thank you, everybody, and have a wonderful afternoon.